Hello, Finance 2. Okay, I want to talk to you about this Chapter 16 problem. Right now, we're looking at the key to the problem. And so I want to just show you the best way to set it up. Right here, after you read the problem, here is all the input data, collections during the sale. Month of sale is 10%. Collections during the month after the sale is right now at 75%, and during the second month after the sale is 15%. Now we're going to do a sensitivity analysis on sales at the end of the problem. So the best way to do it is to set it up, put a fixed 15% in here, and then right here put in a formula. 1 equals 1 minus this E, this cell, and this cell. That way, whenever we change this one, it'll also automatically change our collections on the month after the sale. All these are fixed inputs, givens from the problems, your depreciation, your income tax, miscellaneous expenses, etc. Also, we're going to do a sensitivity analysis on the sales, whether our sales go up or down. So make a sales adjustment factor. When you do that, just put in 0, and I'll show you how to figure that out. Okay, here's our sales that are given for each month and our raw materials that are given for each month. Okay, now when you start to prepare the budget, your sales, what you need to do is multiply your sales, make a formula to multiply your sales times your sales adjust 1 plus your sales adjustment factor. That way that whenever we do our sensitivity analysis, it'll figure it in there for us. And do that for each month. Okay, then our sales during the month after the sale. During the month after the sale, all we've done is take our sales for that month times our month after the sale, which let's see, excuse me, our month after the sale, or the month of the sale, excuse me. So it's times is 10%. Okay. And then first month after the sale, okay, what we're going to do is a month later, we're going to collect 75%. So that would be this times this. That's when we're going to collect in July. And the second month after the sale, we're going to collect the 15% right here from May. We're going to collect it in July. So that's how you find your collections. And then this is just a sum of your collections, total collections. Okay, now here are our raw materials, labor and raw materials. That's what it cost us during the month. Okay, we didn't pay it till the next month. So you'll notice that the actual payment comes here. Okay, so we just brought down our collections, brought down our raw materials for each month, and then we've also added in our other different payments, salaries, lease payments, miscellaneous expenses. You'll notice income taxes are paid quarterly. Income taxes are paid quarterly. And we've got our design studio payment in here in October, I believe. Okay, so this is just a total of all your payments, just the payments you've made. And this is the net cash gain or loss for the month. So it will just be your total collections minus your total payments. All right. The problem tells us that we get $132,000 at the beginning of each month, or at the beginning to start our month of July, I guess. Okay, when we add 132,000 plus this 69.3, we have a balance of cumulative cash of $2,300. Now our target cash balance is $90,000. Okay, that's what we need on hand. So we have 11. When we take 90,000 out, we'll see that we have 111,300 too much. So we need to do something with that cash. Maybe put it on a note, put it in a money market, put a short-term CD, something like that. Now, your cumulative cash balance for the end of the month will be the cash at the start of the month. Okay, and then you just take each out. And you'll notice as you go along here that in the month of, whatever month this is, of September or October, September, we're going to need 155. That's our maximum loan. So what we've done here is just done a minimum function and found our maximum loan, and we just put a minus sign in front of the minimum and put a minus sign in front of the minimum to make it a positive number there. Okay. Go through and answer your questions. Okay, now when you want to do the sensitivity analysis, okay, here's the way you do it. I'm going to delete all this. Okay, our sensitivity analysis. These are just fixed inputs that I've put in, 0, 15. So if our sales, if our collections in the second month go from 0, 15, 30, 45 to up to 90%, okay, we want to see how our maximum loan is. If our sales change, here's our base rate, and if they go down or go up, okay? Now, here is our E57. If you'll go back, we have to put this E57 right here, okay? So it's there. Okay, so now what we do is we highlight all that. Okay, now we want to go to data. We want to do what if, and we're going to do a data table. Okay, so now the data table, when we look at our row input going to go up here and find our row input as collections during the second month. So that's what we're going to replace right there. Okay, now our column input, if we look at our column input, that is going to be our change in sales. So that's where we're going to put our sales adjustment factor. So we'll come up here to our sales adjustment factor. We change our sales and click OK. We go down and look at our data table. And there we go. So now we know if our base case was 0 and 50% collections in the second month, we're going to need a loan of $155,100. If our sales go down 100% and we collect 0 in the second month, we're going to need $2,226,000. So you can see how our loan requirement changes. You can see more realistically maybe if our loan say sales change negative 25% and we collect 30% in the second month, we're going to need $517,800. Now, if we have an increase in sales of 15% and maybe we collect 30% in the second month, well, we see, hey, we're not going to need, we're going to be a surplus. So there you go. That's an example of how to do it. Good luck.